So the income statement is the statement that we will use to understand a company's profitability. In other words, we're comparing sales made to customers less expenses. So we're trying to say how much profit is the company deriving from operating its business. Now, what's interesting about analyzing the income statement is oftentimes financial statement fraud is uncovered through analyses of the income statement. A recent example, in 2020, a company called Mohawk Industries, Inc. was sued by an investor claiming that the executives of the company inflated revenue, inflated sales dollars in the financial statements so that they could boost their own performance-based compensation, things like bonuses and equity awards. So the investor sued Mohawk claiming that revenues were artificially inflated for the financial reports by the executives so that the executives could increase their own performance-based compensation. So an interesting case. Academic research has also looked at financial statement fraud and bending the rules related to the income statement. So in an experiment by researchers at the University of Nevada, Las Vegas, the researchers presented opportunities to increase profitability to participants, and they had one of two options. They could artificially inflate revenue, or they could delay expense recognition, delay when they record expenses in the income statement. And predominantly, the choice made by the participants was to delay expense recognition to increase profitability. So you delay when expenses are recorded, you increase current period profitability. So fraud can be committed both in terms of overstating revenue, overstating sales, and understating expenses. Both are possible.
Also, don't forget to like and subscribe to our YouTube channel so you can stay up to date with our latest content and tips for the exams. Dive into our collection of free prep videos and materials through the links provided below.